Hello everyone and welcome once again to Market Thoughts. I am Will Hassel. I am a content contributor for the Financial Bulls, Captains of Capital, and the Leaders Investment Club. And I know it's been a while since I last did one of these videos, but that's the new theme of why I'm doing these, is to go and give time for markets to develop so I can talk a little bit more in depth about how I specifically view them. I am a longer term investor and trader. So, getting into the markets, we have had a pretty interesting start to the year. I did my last video at the beginning of January. Right here, markets have just been pretty crazy over the last 3 months, and this is a 3-month chart, up until the start of February, where we decided to get our act together off of a good jobs report from January. And data's been a little bit mixed. We've seen retail sales kind of disappoint. We've seen PMIs and CPIs, which are gauges of inflation, kind of mixed. Europe was in deep worry all throughout January about what was going to happen there, and we're actually starting to see some better than expected numbers out of Europe. All with this kind of Greek debt debacle that has just recently kind of been solved. I don't want to say it has been solved, because we've seen deals be accepted and withdrawn so many times over this past month that there's really no real need to go and say, hey, this is a done deal. Although it does seem like this time it is built to last versus other times. So this is the chart of the SPY for 3 months. As we notice here, mid-December there was a lot of volume. This was a pretty steep decline. I think it was around 5% or so. January was mostly up and down, flat to down. Markets were red up until February, where markets actually turned green around the beginning of February, and then they've just gone up about 5% ever since then, as you can see here from implied versus historic vol. Nothing really going on in the big kind of spreads, other than like in December you saw those huge spreads, which I like this as a time to go and see when the market is, acting a little bit overdone. We're going to go and look at bonds, the TLT, which when I go and I compare it with the, I'll make that the SPY. When I compare it with the SPY, you'll notice that as they've started to diverge a bit ever since the beginning of February. Bond yields have been going up. The TLT is a way to go. The TLT price goes down as bond yields go up. So you've seen this divergence, and then right at February they started to come back again. If I blow this chart out to a 1 year, you'll notice at some points in times where they diverge, like in October when you have that big swoon, they start to come together, diverge, and I think they're probably going to come together again. But then again, we could have a bad jobs report and bond yields could fall dramatically. I know a lot of people are expecting rising rates, but you know what? I don't know if that's in the picture. I think it may go to 2.5% on the 10-year. I don't want to get too into that just because I'm not a bond yield person, but I think 2.5% because of what the Fed's going to do with raising interest rates down later into the year, possibly September, and just seeing some good signs out of the U.S. economy. The labor participation rate is a big is a worry to me. Although you are starting to see the real what is considered the real unemployment rate at about 7% versus 5%. That's when you factor in the labor participation rate. So so there is some room to grow on the jobs pictures, and we have been having fantastic jobs numbers. I think the 6-month average for ADP reports is under 300,000, which is absolutely fantastic. We have seen over 250,000 job reports come during the months. We saw one in December or November. I believe it was December. No, it was November's jobs report, which was in December, where it jumped over 300,000. We're starting to see wages increase. So the jobs front looks good. Deflation, the deflationary pressures have been worrisome. You're seeing orange juice fall. You're seeing coffee fall dramatically, which is good for Starbucks, but bad for the Fed's inflation target. With that, I want to start diving into a theme that I've been seeing within the markets. We just had earnings season. We saw stocks, oil stocks in particular, get absolutely hammered. I think EOG was one of them, if I want to say. Yeah, you've been seeing stocks get hammered. Pandora. What you're really seeing is what I'm trying to get to the point here is you're seeing a huge divergence in stocks that reported great earnings and stocks that didn't report great earnings. JP Morgan Chase, I own it. They reported pretty weak earnings and they fell dramatically. I think it was like a 6% drop or something like that. They've since recovered it. Qualcomm comes to mind once again because I own it. It had this huge 11% decline. I made a trade there at 65, and it's just now come back because the Chinese, the settlement with the Chinese has finally gone through. They paid out. The whole reason why it fell so much was there was worries about Samsung not using their using Qualcomm Snapdragon chips in their phones. Turns out they're not. But they're still not taking them out of all of their phones. And this whole when will the whole China thing be resolved? And it got resolved right around here, and it just started bouncing back higher and higher and higher. So it was like all the bad news has gone away from the stock, which is something that I truly believe. I also think Qualcomm's a deep value play. I'm just going to type it in to my desktop computer because I film these on my laptop. With a forward PE, with a PE of 15, a forward PE of 13, EPS this year is expected to be $4.73, and EPS next year to be $5.33. You are essentially this is a name with a 13 forward PE, which is absolutely fantastic. It's got about zero debt on its balance sheet, and it pays out around 2.5%, a year. So it's got plenty of cash on its balance sheet. It's paying you back. They're buying back stock. It's a great company to own if you think mobile will actually do anything throughout the year. Which actually brings me to a major theme in my portfolio, and that's mobile use. I have Apple, which we can discuss because they did have a great earnings report, and that's why you see the stock jumped up, kept going. It's going to get to 130. It will get there, believe me. Apple, great earnings report. There's talk now. I actually worry about Apple's future, and I know in the past I've been a huge hypocrite of Apple because, and people have criticized me for saying that because I don't own the stock. I missed out on a whole bunch of gains. Well, I own the stock. It's the best performer in my portfolio so far this year. And I have to say I'm worried. A big announcement was made during one of the tech conferences. It was Tim Cook said that they are going to go and pay SolarCity something around just under $1 billion for a couple hundred acres of solar fields for their data centers, and for some reason everyone thought that this was absolutely incredible for Apple. It really isn't. I know a lot about data centers just because my dad is in the field of building data centers. He actually built what was the largest solar array on top of a data center in St. Louis, Missouri for the company that works for Emerson Electric. I do not trade Emerson at all, do not own any for conflict of interest reasons. And he said that solar array takes 18 years to pay back the cost that it had. And he says it's going to be about the same for Apple, but when Apple has that much cash, he says that they can just throw it at stuff like alternative energies for their data centers and not even care. So my point is, the fact that they are using solar panels at their data centers isn't actually a big deal. It's almost worrisome to me because of the fact that you are going to go and get this huge capital expenditure that isn't really going to pay itself back until, I am 38. So I don't see it as a huge thing for Apple, really. solar is, I mean, I like the idea of renewable energies, but solar, just the efficiency and all that is way behind the times. They're doing it for tax credit reasons. They're doing it for reasons that aren't just Tim Cook wants to save the planet. Another thing about Apple is recently they've gone and disclosed that they're thinking about producing cars by the time of 2025. I have no idea why they'd want to do that. The only legitimate answer to that question that I've heard is John Ford from CNBC saying that it's this race from Google, from Facebook, from Apple to be the first one to truly integrate your life into their platform. For Apple users, for hardcore Apple users, it is truly integrated because you can go from your iPhone to your iPad and all that stuff. And the same for Windows users. But at this point, I don't know why Apple would waste their time with cars. Cars are a hugely cash draining business. Even though Apple has a lot of cash, I would like to see them do work with that cash, but I want to see them do work in the technology space, not a car space. You know, they could buy Tesla if they wanted to and still have a lot of cash to go and redo it, but that would be a terrible investment. Just the thought of Apple making cars is a little nervous. It's a little nerve-wracking to me. It's one thing for Google to make, to help make self-driving cars and the software for self-driving cars, and Apple with the same. But it's another thing to take on and manufacture cars all in general. It's a lot of research and development. It's a lot of trial and error. It's a lot of infrastructure that they're going to have to build out. And, even though they have the cash to do it, the question is, will it actually work? And will that bet actually pay off? I mean, a great tweet that I saw out there by I'm blanking on his name, but it was I can't wait to pay $100,000 for a Kia Soul with an Apple logo on it. And I think that's what's going to happen. And it will turn into a luxury car company where only a couple, 100,000 are sold a year. And it just really doesn't move the needle for the true Apple users, which are, middle class people. I mean, Apple is supposed to be a luxury company, but you look around at any type of restaurant and you see everyone has an Apple device. So will everyone be able to buy an Apple car? I don't think so. I would like to see them venture more into wearable technology. I know the Apple Watch is coming up, but I don't think cars are the way to do it. I really don't think. I think the software side of it is brilliant. I don't think the actual physical production of cars is going to be worthwhile. Going back to the theme of this market theme of companies that reported great earnings are outperforming. Starbucks reported a monster of a quarter. They went up about around 6-7%, and they've just been making brand new highs through the entire year. They're one of the best performing stocks of the year right now. They're coming out with, great beverages. They're having great results. Mobile payment is going out great, and they had their single most Starbucks cards ever purchased this last holiday season, around 7 million cards. So you got to think of that in terms of if there's at least $1 on every card, that's $7 million of returning customers. You do $5, that's $35 million, dollars of revenue. And what's interesting is that their mobile payment platform will grow too, because a lot of those cards will be converted. They have around 9 million users on their mobile payments platform. It's growing like crazy. Coffee prices are only going to help them because they have half of their coffee exposure hedged out through 2015. They've been waiting for an event like this for coffee to decrease so they can buy, and better hedge themselves. They're going to do that, and they're going to nail it out of the park. And, I would not bet against this stock. I think it's going to 100 at least this year. I would like to go and see how well they do in the upcoming quarters with low gas prices affecting the consumer. I think this is an item that the consumer does use a little bit of that gas money with, although companies have been saying that they've been saving it more than spending it. But I think, that just a subtle shift from buying a tall to a grande or a grande to a venti is going to be that much of a difference for Starbucks, and it's going to be people buying another Starbucks card, or buying that extra bag of coffee, or buying that bigger drink, or buying that Frappuccino at a larger size, or that extra Frappuccino that's going to do it. And they're going to have a lot of new products coming out in the summer, and it's just going to be very interesting to keep watching them. Disney is another company that I own that reported an absolutely monster quarter. It was up 12% on that day, and has just been making 52-week highs ever since. And they just absolutely knocked it out of the park with the Frozen merchandise. They saw great sales from their movies like Guardians of the Galaxy. What's actually interesting is last year was one of the slowest years for movie goers in a while, and one of the big things to pay attention to was what will happen to Disney. I mean, they had Frozen, they had the college playoff, they had the World Cup, and is this all baked into their earnings? And I mean, they do trade at a rather expensive-ish multiple. I mean, their forward PE is 18, their PE currently is 23, but I start thinking about the context of it, and this year was feared to be a slow movie-going year, but we just had 50 Shades of Grey, do almost $250 million in global revenue for that opening weekend. American Sniper brought in a whole bunch of money, and I look down the pipeline for Walt Disney, and I go, okay, the new Cinderella movie, the live-action Cinderella movie is coming out later, and that's something that's good against broad audiences of viewers. Star Wars is going to be coming at the end of this year, and that's going to be an absolute monster event, and that's one of the reasons why you hold the stock at least through a year from now into that earnings period, at least a year, just because of Star Wars alone. And then you have essentially Marvel almost for free, because they're starting to build out the newest Marvel film as well, and that's going to be released along I believe it's either the end of this year or the beginning of next year. So the question of will moviegoers continue to go to the movies, I think yes, because you're seeing great numbers from the movies right now, and there's that anticipation factor of Star Wars and of the other Disney movies that are going to come out. ESPN is just knocking it out of the park again with their content. They made a whole bunch of great deals with the NBA, the NFL, and they're just killing it again. And that's why that's why they're outperforming, is because they delivered on earnings, they beat expectations, and their forward guidance is just incredible. Under Armour was an interesting quarter. They didn't have a huge earnings beat. I mean, they did-ish on revenue, not so much on EPS. Here was their earnings day. It popped. It was a lot of whiplash. It was up 4%. It was down 2%. Stayed flat at the next open. But it had this massive run up from January. I mean, this was a 10% run that just kept going and going and going. And it just went, and if you look on a yearly chart, it just broke through its 50-day moving average just a little while ago, and that's been delivering it up a bit. You look through very, very low volatility. What was actually really, really interesting in Under Armour's quarter was that they purchased Endomondo and MyFitness, and it's either MyFitness or MyFitnessPal. They owned one. They definitely bought Endomondo, and what they're doing is they are acquiring these mobile fitness companies to better integrate onto a mobile platform. They already had the One Fitness mobile fitness company, and now they have a collective 120 million users across the planet. Endomondo is a European company, so they have about something like 50 million users over in Europe alone. And what Under Armour said that they're trying to do is they're building into wearables. Your shirt's going to be able to talk to your phone and tell you, what your sweat rate is and all this. Under Armour actually has reached out to several of the users of these apps for things like for when they buy Under Armour shoes, telling them when they bought the shoe, how many, and being able to access the data of how long they've run, and telling them when their shoe wore out or when they stopped wearing the shoe because they thought it was worn out. That way they can go and track also the the life cycle of their products. Kevin Plank went on Squawk Box and he said, he doesn't see in the next couple of years us carrying around these 3x5 inch pieces of glass in our pockets. He says it's all going to be wearable. We're moving into an even more mobile society, and Under Armour is placing themselves ahead of the curve for this. They're building out an expansive user base, across mobile fitness, and they're just going to start integrating their products with mobile. And it's going to be this incredible company of mobile with fitness, all communicating. Their European sales, their ex-US sales were actually pretty good, despite the worries about what's going on in the global economy. And I think you're actually going to start seeing them outperform. I think it took a while because a lot of people were confused why they're buying these internet companies, why they're doing this, why they're doing that. And because it wasn't a huge beat like Under Armour's used to when they beat for these huge pops, I think it took a while for people to investigate actually what their earnings did, instead of just saying, they beat by 12 cents, like over here where they beat by like 5 cents on sales, so they immediately popped the stock up like what was that, $10. It actually took people a while to sit there and go and think about what Under Armour's doing. And I think that's another stock that's going to definitely outperform as the year goes on. And that's been, this is what I want to hammer home, is that there are these that you're starting to see more and more as some of the oil companies missed, such as BP, that as these oil companies miss, as other companies miss, you're looking for a flight to quality, a flight to companies that have beaten on earnings and have a track record of doing so, of these companies that people are looking for the solids. They're not looking for a huge bet like Tesla, where they absolutely bombed their quarter. I don't know why the stock went up all as much, probably because Elon Musk said that they're going to be going in, becoming like Apple, because he sees them seeing a 20 PE, even though their current PE is, I believe, negative 300. And they actually burnt through more cash flow than, their EPS for this year is negative $2.35. And to me, Tesla makes absolutely no sense. They spent, over 50% of what their revenues were on CapEx. Their cash flow is the most negative it's ever been. To me, I think they're going to have cash problems along the way. I don't see it. I really don't see it happening. They could be a great takeover target. People thought Twitter is going to get bought by Apple or Google because they've been having Twitter has been in the spotlight because people have been asking for Dick Costolo's head for, he hasn't been running the company that well. They saw ad growth, starting to go. They're talking about more monetization of ads, and just checking my time here. And because they beat on earnings, you saw the stock go up. Because, like I said, a flight to companies that are growing earnings and companies that are strong. GoPro was one that initially they beat, and then after the beat, they said, one of our chief operating officers is going to be leaving the company, and then that sent the stock going down. It was initially a beat, but people were worried about why people were jumping ship. And ever since around October, it just hasn't been working out. It just hasn't been working out for camera on a stick. And a lot of people are asking, when are they going to be creating this content? It's going to take a while for this content to be created, and there's a lot of skepticism in the stocks. There's a lot of skepticism in a bunch of stocks. Whether whether they're actually going to perform or not. And I know people say this a lot, that it's a stock picker's market, blah, 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 but to me it actually is a stock picker's market. For me, which I am a stock picker, that's good because I have built my portfolio around companies that have great earnings growth, have, tangible earnings growth. And I think if you move your portfolio into stocks that, grow earnings, like Disney, like Starbucks, like Apple, you will see the fruits of that as the year goes on. If you want to keep chasing some of the momentum stocks, go right ahead. I can't really suggest anything for global macro just because I'm not that too familiar with it or currencies, but I think it may be an interesting year definitely for interest rates because the Fed's going to raise. You have European QE, so that shakes up the landscape a little bit. Japan is starting to get really interesting what they're doing over there, whether they're hiking, whether they're doing sales tax, whether they're going to keep doing QE, whether they're not going to do QE. Abe's third arrow is starting to get a little, it's starting to come around, so keep that in mind. China's getting interesting because of possible credit crisis going on over there. And right now, the U.S. is king when it comes to economic stability. And I think if you park money in the U.S., I think you'll do well. I think if you park a little bit money over in Europe, for European companies, if you play broad Europe, like Germany with the DAX at a new all-time high, if you start picking selective companies over in Europe, I think you'll do well over there as well. But I would mainly stay in U.S. companies that have great earnings growth. Like I said, my biggest picks have to be Starbucks and Disney. They have to be Starbucks and Disney. I think if you stick with those, they're going to be huge outperformers for this year. And I'm going to wrap it up here. I just want to thank all of you for staying and listening to my rambling. Please go out there and check me out on the Financial Bulls, on the Leaders Investment Club, on Captains of Capital. Please shoot me emails if you have questions. Tweet at me. My Twitter handle is at WillHasselWS. Please tweet at me if you want to hear something new in the videos. Please feel free to do feedback. If you want to argue with me on one of my calls, like you think, oh no, GoPro's going to go to 80 instead of 40. Please, argue with me. I'd love to hear what you guys think. I love interacting with you guys out there. And hopefully I see you guys next time. Thanks.